Well, the Federal Reserve moving markets today, this after announcing that they were going to lift their key interest rate by 25 basis points or a quarter point. The Fed, it's the second time this year that they've done it, and they project two more rate hikes for this year. Chair Jerome Powell citing a very strong labor market as the main reason why. And he's very confident this economy is going to continue to grow. Joining me now on the panel, Nomi Prins, author of Collusion: How Central Bankers Rigged the World, Mattie Duppler, Independent Women's Forum, and also a visiting fellow there. And Liz Peek is with us, FoxNews.com columnist. Nomi, let me start with you because you've been extraordinarily critical of the Federal Reserve and all central banks, and I think it's your premise that at some point they're going to collapse our economy. Was today the first step toward that?
Well, I think the fact that the market did sell off as opposed to rising on what Powell characterized as strength is a sign that there's confusion as to whether or not rate hikes actually do indicate or do reflect economic strength. The Fed did say that growth is going to be up by 2.8%. That's only 0.1% up from what they originally forecast. That's not really a sign of massive confidence in strength. And I think that's why the market's sold off. And I think that's why we're seeing this kind of inflection. I think we're going to continue to see it throughout the rest of the year.
Yeah, Mattie, the Fed did adjust their economic projections for the year from March. Yep. They see the economy, the GDP stronger, unemployment lower, and just inflation just a tad bit higher. They're getting close to 3%, but Jerome Powell went out of his way in his interview today really to laud how strong he thinks the economy is.
Yep.
He also went out of his way to say that even though they made a lot of changes, we shouldn't be worried about it.
Right. Yeah, and he said exactly what I've been saying on this program for the last several weeks and last several months even, which is that the fundamentals in this economy have evolved to a point where we really feel strength. And I think what the Fed expressed today is basically that they stand with where the American people feel right now, which is they feel their economy improving. Now, looking at what we heard today about the fact that there is an interest rate hike, but that there will be 2 instead of 1 in the coming year, I think that what we need to really do is take a step back and try to release ourselves from what has been the last 10 years of this constant Fed watching and all the pearl clutching and hand wringing that goes with it. I think right now a lot of prognosticators are looking at this and thinking, okay, if we're going to actually get clarity from the Fed for the next 6 months as to what we're going to see, what does that look like in terms of market reactions? I think expectations need to start to be realigned with our policy.
Now, Chairman Powell went out of his way to say the economy's done extraordinarily well, particularly since he came in 2012, but in the last couple of years. And he's saying from where we are now, there will be more jobs out there. Wages are going to start increasing. And then even folks on the margins who couldn't find work for a long time, even Liz, they'll start to find work. But, I heard someone ask a great question, and why are you hiking rates now? I thought that was the best question. He didn't answer it clearly at all in my mind. He sort of dodged that one. And that is the question, why does the Fed get involved? And particularly now when this sort of economic renaissance is just now bubbling up, is just now gaining momentum, why would they even begin to start putting these sort of, derail it at all?
I think every Fed chair is haunted by the idea that they're going to miss an inflection point. And I think
so they're going to create it themselves.
No, I don't think that's true. But I think we're seeing from, for example, the National Federation of Independent Businesses, we're seeing from consumer surveys, every indication is that the job market is red hot. People can't find workers. And what did the NFIB talk about this week? That their constituents, small business managers, are raising prices in a way they haven't done in probably 2 decades. Right. So wages are going up and prices are going up. We saw it with the CPI numbers recently. I just think they want to make. I read this announcement today from the Fed as really maintaining maximum flexibility. I think they're ready to step in a little more aggressively if need be. They may do it this year. They may not. I think we'll see.
Nomi, what do you think for the rest of the year with this Fed, with this Powell Fed?
I do agree on the flexibility issue, but I think they also are trying to preserve flexibility if things slow down. Again, they only increased their forecast by 0.1% in terms of growth. The GDP only grew 2.2% last quarter.
So you saw that as a red flag.
I think there's one thing on wages, one thing on growth. So I think they give themselves room either way. I think that's one of the reasons that the yield curve has been flattening. It's kind of showing that we might grow, but we also might have to recognize what's going on in the world, the uncertainties and so forth. And so there is some firepower left in case the Fed needs to stop raising rates and to kind of keep it in check towards the end of the year.
Well, I've always said it's the next day where I assess the market and the Fed, because the 2 hours after the FOMC, it just gets crazy bonkers. So we'll see what happens tomorrow once we've all slept on this. Thank you, ladies, very much.